FOMC meeting approaches tomorrow. What's the Fed going to say? How is that going to impact the markets and your money? That's coming up on 3 Minutes on Markets and Money. So tomorrow's the big day, of course. The FOMC is expected right now to hike rates by 50 basis points and to announce the tapering of their balance sheet starting in June, roughly about $90 to $95 billion a month. That's the expectation, and as long as the Fed comes in and stays in line with expectations, we could see the markets actually rally tomorrow on that news because it is so widely expected that that's exactly what they're going to announce. The risk and why markets have really kind of struggled this week is what if they do something more hawkish, right? What if they hike 75 basis points? What if they become much more hawkish on their view about combating inflation? That's the risk, and that's where markets have really been trying to position this week ahead of that meeting. Our expectation, though, is with the market so negatively biased, any news from the Federal Reserve that is pretty much in line with expectations is likely going to lead to a reflexive rally in the markets. Now, again, not talking about a huge reflex rally here, but a rally back towards the 50-day moving average is certainly well within the context. One of the problems we've got going on just on a short-term basis is markets are in a very negative downtrend at the moment. This is certainly weighing on asset price. It's also putting a lot of overhead pressure on markets. That downtrend line right now coincides with exactly where the 20 and the 50-day moving average are crossing. So there's a lot of resistance here overhead in the markets in the very short term. Markets, though, are very, very oversold on multiple levels, from MACD to our money flow index to the Williams percent R. We are very oversold. These conditions generally, as we've said before, align with temporary market bottoms. Again, doesn't mean that you're going to have a super strong rally, but it does suggest if we don't get any bad news, markets are likely to rally just from the function that sentiment is so negative, positioning is very negative, and as we're moving into the end of the quarter, which is in June, portfolio managers certainly don't want to go through that entire period being that underweight equity. So again, there is a certain amount of upward potential here just from everyone being so negatively biased in the markets. Also, yesterday, the buyback window for corporate share buybacks, which the announcements so far are running near a record for buybacks. Buybacks could amount to about $5 billion a day over the course of the next month and a half before we get back into the next blackout period for Q2 earnings. So that could also help provide a little bit of lift to stocks in the near term as well. But the real key point here is that there has been so much negative news in the markets that a lack of bad news doesn't even mean we need good news. If we just have a lack of bad news, we could see the market start to rally here a bit just on the expectation that news really can't get much worse than it's already been. So again, the big catalyst for tomorrow is going to be the Federal Reserve. If they announce exactly what's expected, 50 basis point hike, a tapering of balance sheets of 90 to 95 billion a month, exactly what the markets are expecting. And if there's any news from the Federal Reserve talking about maybe a peak of inflation maybe being behind us, that could also help give us some additional lift to equities here in the short term over the next week or so. That will provide the opportunity that you're looking for to rebalance your risk, reduce some of your equity exposure, raise a little bit of cash. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll be back tomorrow.